Happy New Year, everybody. It is officially 2023. I am dubbing this the year of opportunity. I have a funny feeling that at some point during the year, the stock market may realize that it has collectively made a slight error of judgment in assessing the fair value of certain securities, including Tesla. Now, I could be wrong. I hope I am, because I'm still buying. But given the fact that it's a brand new year, I thought I'd put this on the record and then see how this prediction ages. Of course, it's not just me who sees opportunity in 2023, and that is the subject of today's video. We're going to be looking at some research and new note from none other than Morgan / occasionally Moron Stanley. I hope at this point most of you have set your goals for 2023, and if not, my condolences. I've already posted my first exclusive Patreon video for the year, and there'll be plenty more to come. Check it out with the card in the corner or the link in the pinned comment. And to those of you who successfully passed yesterday's IQ test, I'm obnoxious. In all seriousness, please let me know in a few weeks' time how you're feeling. If you're wondering what IQ test, check out yesterday's video. Let's get into it. D-rating creates opportunity. Cutting price target to $250 per share. Reiterate, overweight rating. So Morgan Stanley, aka occasionally Moron Stanley, cutting their Tesla stock price target to $250. Definitely not because they're chasing the stock down and trying to remain relevant, but obviously because they've updated their valuation model. We see Tesla's 45% December sell-off, driven by EV supply being greater than EV demand for the first time since the plague. Now, spoiler alert, this is wrong. This is going to be embarrassing. It's not going to age well, but let's continue. This is a new thesis that appeared out of absolutely nowhere. A lot of people now suddenly under the strange assumption, which is not going to age well, that there is now going to be more supply of electric vehicles than there is demand for electric vehicles. I just can't even. Exacerbated by technical factors. Price target cut to $250 on lower pricing and lower valuation of adjacent businesses. Reiterate, overweight rating on valuation, cash flow, innovation, and cost leadership. What's changed? Price target reduced from $330 per share to $250 per share, which, by the way, is still more than a doubling from where Tesla stock is today. The average Wall Street price target on Tesla stock now is more than a doubling from where it is today. I can't recall the last time this has happened. In fact, I don't know if it's ever happened in the history of Tesla stock. That speaks to the absurdity of Tesla's current price, in my opinion. We believe 2023 is shaping up to be a reset year for the EV market, where the last 2 years of demand exceeding supply will be substantially inverted. Oh, this is going to be really hard, dude. Let's keep rolling. It's substantially inverted due to supply exceeding demand. Within this environment, we believe players that are self-funded, e.g. non-reliant on external capital funding, aka companies like Rivian Lucid, still reliant on external capital, company like Tesla, self-sustaining, not reliant on capital, with demonstrated scale and cost leadership throughout the value chain, from manufacturing to upstream material supply, can be relative winners. And a rather telling comment here. We believe Tesla may, spoiler alert, will, be in a position to extend its lead versus the EV competition in 2023, both legacy competition and startups, even before consideration of the Inflation Induction Act benefits, where Tesla also stands out as the biggest potential winner. I agree with all of these points. Curiously, the stock market seems to have completely forgotten about the $7,500 tax credit. That's what happens when you have a micro-penis length time perspective. On a relative basis, the reiteration of our overweight rating must be seen versus more challenged EV-related peers, such as EV-rated Vista. Did I say that right? Probably. Underweight rated Lucid Motors and underweight rated QuantumScape. Between a worsening macro backdrop, record high unaffordability, and increasing competition, there are hurdles to overcome. Yet we do believe that in the face of all these pressures, Tesla will widen its lead in the EV race as it leverages its costs and scale advantages to further itself from the competition. Now, we've got to take a moment to talk about this. This is brilliantly articulated. People don't get this. Tesla's already in the lead. Not only that, but their lead is accelerating. While other companies, including legacy automotive manufacturers and EV startups, are trying, keyword trying, they haven't already done it, they're trying to successfully ramp volume production of their EVs. That's step one, make them at volume. Step two is to be producing a profit on each of these vehicles, because currently they're not. Outside of China, Tesla's like the only company making EVs that's actually making money on any of them. So first, get to volume production without going bankrupt. Second, drive the cost down so you can actually make money on these vehicles, because there's no point selling tens, hundreds of thousands of electric vehicles if you're losing colossal amounts of money on every single one. The next step is to improve the value proposition so consumers actually want to buy them. And the final futile step is attempt to get closer and closer to Tesla as they continue to pull further and further into the lead. It doesn't end well for anyone other than Tesla. Just the facts. While we adjust our forecast to reflect our views on lower ATPs and the risks of ADAS commoditization, they're basically talking about full self-driving type features being available universally on all vehicles. Good luck with that. We still see there being an attractive entry for investors as Tesla approaches our new $80 bear case, as well as a sub 10 times 2025 EBITDA multiple. Yeah, this is absurd, dude. The big lesson I learned in 2022, my hypothesis was if Tesla got absolutely wrecked beyond a certain level, maybe down 50, 60%, big institutional investors come in, oh, dude, this makes no sense. It's way too cheap. Let's buy this thing. I mean, just absolutely detached from reality. Well, it turns out that didn't happen. I mean, again, when we look at Tesla, the valuation of the company versus future earnings, it is the disconnectable disconnects, hence referring to 2023 as the year of opportunity. A word on Tesla China. According to Morgan Stanley lead China auto analyst, NIO has announced a cut to Q4 delivery target given the plague-related disruption to production and registrations. Despite sequential volume improvement, the uptick of auto/new electric vehicle sales has come in weaker than expected, given a surge in plague cases following the reopening. Our China team believes the headwinds will persist at least through January and early February after the Chinese New Year, during which time employees will begin arriving back at factories. According to a variety of local sources, Tesla has temporarily stopped production of the Model Y at Giga Shanghai in recent weeks, as far as we're aware, due to production line upgrades. Don't tell that to the fudsters. Tesla's delivery statistics in China have almost halved from 14 to 16,000 a week in late November to 8,000 last week. Once again, just need to remind everybody that the Shanghai factory is also Tesla's main export hub. So there's going to be huge weekly, monthly, and even quarterly variations between the number of vehicles produced at Shanghai and sold in China versus produced in Shanghai and sold elsewhere. Because again, this is where they make the vehicles they export, because that's the lowest labor cost, the lowest production costs, the lowest material costs. They have the highest margins. Given the fact that it doesn't make economic sense for Tesla to have a factory in every country they deliver vehicles in, the logical place to be exporting from is the place that has the lowest cost to produce your vehicles. I mean, duh. I think people read into the China numbers a little bit too much, especially with domestic deliveries. What you want to be looking at is a total production month over month. How many vehicles are being produced? And then of those vehicles, how many are being sold on Earth? Not in China, on Earth. Let's move on. The team expects Tesla China and other major OEMs will still attempt to make efforts to push sales through year-end, but this could create downside risk to production in the following weeks. From a sentiment perspective, the team in China believes news flow has the potential to get worse before it gets better. Thoughts on Q4 deliveries? We estimate 399,000 units delivered in Q4 versus consensus of 429,000, and our data provider EV volumes is at 440,000. Our conversations with investors suggest buy-side consensus is between 410 and 425,000. Changes to price target, bull case, and bear case. Price target. We reduced our price target to $250 from $330 previously. Of the reduction, $43 is related to core Tesla Auto, where we have factored in greater levels of price discounting, and still no assumed benefit from the Inflation Induction Act. I'm not sure why, but okay. $12 reduction from its mobility and $25 from its network services, where we have increased our probability discount. By the way, isn't it curious that after all these adjustments, these totally arbitrary adjustments, suddenly the price target's a nice round number of $250 per share? Are we ever going to see a price target from Morgan Stanley that suggests that it's a direct output of changes to the valuation model instead of fudging the numbers to come up with a narrative? Like, seriously? I understand maybe people just want to round it a little bit and keep it clean, but I just distrust a price target. It looks clean and neat. $250, $275, $300. Why isn't it $241 or $263? Like, you understand what I'm saying? These rounding numbers just, it looks fake and phony and forged to me. It doesn't seem genuine. At our revised $250 price target, Tesla trades at 24 times our 2025 EBITDA and less than 5 times 2025 sales. Absurdly cheap in my opinion, and I personally believe their estimates are massively under the mark, meaning it's even more absurd. Core Auto. We now value Core Auto at $139 per share compared to $183 per share previously. While our unit forecast remains the same across our forecast horizon, we now forecast lower revenue and margins, with our 2030 EBITDA margin now standing at 19.3% compared to 20.9% previously. Additionally, we lower our EV EBITDA multiple to 12 times from 15 times previously. At $139 a share, the automotive business trades at around 15 times our 2025 auto EBITDA. Mobility. Our valuation for Tesla Mobility now stands at $9 a share versus $21 a share previously. We now assume a fleet of 425,000 vehicles. By the way, this is robotaxis if you're not reading between the lines. A robotaxi fleet of 425 vehicles by 2030. Can someone remind me to clip this in 2030? 425,000. That's not 42 million. That's not 4.2 million. That's 425,000 in 2030. A 12% operating margin and $1.70 per mile with a 3% terminal growth rate. Network services. We now value Tesla Network Services at $33 a share versus $57 a share previously. Our revised assumptions include 20 million monthly active users at an $80 average revenue per user by 2030, compared to 25 million at 100 previously. Just for context, I personally believe around 2030 Tesla's fleet will be approximately 100 million vehicles. By the sounds of this, Morgan Stanley is thinking it's going to be closer to around 20 million vehicles. Looking forward to seeing how well these predictions age. Additionally, we have increased our valuation discount to 50% from 20% previously. The change in assumptions and discount rates stem from our views and beliefs around the significant possibility of ADAS commoditization and our views around what investors are willing to pay for these types of revenue streams today. Bull case. Our bull case now stands at $440 per share versus $500 previously. At our revised bull case, Tesla trades at 18 times 2030 EBITDA and 3.7 times 2030 sales. Bear case. Our bear case now stands at $80 a share versus $150 a share previously. Chasing Tesla stock price much? Seriously? At our revised bear case, Tesla trades at 3.1 times 2030. What the? And 0.6 times the... I can't even read this shit. Holy fuck, dude. Price target bridge. Let me explain what's going on here. On the left here, the prior price target. In blue, 330. In red, these are the reductions. Auto, mobility, network services, getting to the new price target of 250. Changes to our estimates. Deliveries. We keep our delivery forecast unchanged from prior estimates. We forecast 1.8 million vehicles delivered in 2023 and 2.5 million in 2024. I'm having a hard time understanding how Morgan Stanley are getting to these numbers. I really would like to see their breakdown, deliveries by factory. How many are coming out of Fremont? We know Fremont's already well in excess of 500,000 vehicles per year. Shanghai's around 1 million a year. We're already at 1.5. Berlin and Austin are already ramped to approximately 200,000 vehicles per year, so that's another 400,000. And this is assuming no additional ramp up in production at Berlin or Austin, no new capacity at Fremont, nor at Shanghai. I just don't quite understand how they're getting to these numbers. Auto revenues, excluding credits. 2023 auto revenue estimate decreases to 92.4 billion from 95.1 billion previously. For context, my base case is around 105 billion. From 2023 to 2030, our average auto revenue estimate decreases by 4.4, entirely driven by lower ATP estimates. Automotive gross margins, excluding credits. We lower our auto gross margin, excluding credits, forecast to reflect price cuts, though we note there will be a mix of factors that will influence where gross margin shakes out. This is important because there will. Commodity price normalization, good point. Scaling the 4680 structural battery pack, increased gigapressing, increased capacity utilization at existing facilities, increased facility count, etc. Our 2023 gross margin, excluding credit forecast, now stands at 23.2% versus 24% previously, and our 2030 estimate now stands at oh, Jesus Christ. Now stands at 22.5% versus 24% previously. From 2023 to 2030, the average decrease in our automotive gross margin estimate is 4.9%. EBITDA. 2023 EBITDA estimate now stands at 20.7 billion versus 22.3 billion previously. 2030 now stands at 85.6 billion versus 97 billion previously. So, in my opinion, the further in time we get, the further into the future, the less accurate Morgan Stanley's estimates will turn out to have been. Free cash flow. 2023 free cash flow estimate now stands at 13.7 billion versus 14.8 billion previously. 2030 free cash flow stands at 59.9 billion versus 68.1 billion previously. If you guys want to nerd it out, look at these couple of charts, go for it. In particular, change in automotive gross margin forecast. Blue, prior, yellow, new. Significant decrease. Kind of get the feeling that Morgan Stanley aren't factoring in Tesla's ability to continue to innovate in terms of manufacturing, to delete parts and processes, to take advantage of higher scale, better unit economics, deletion of parts in the, if you say so, Morgan Stanley, but I just don't think this is going to age well. More charts, same story. Blue prior, yellow now. EBITDA heading down. Free cash flow also heading down. And if you want to go full nerd, I'll zoom in a little bit for you guys. You can have a pause at this. We're looking at Morgan Stanley Tesla valuation methodology. We can see the bull case, what it's made up of, base case and the bear case. In particular, just a couple of highlights. Bull case, they're expecting just 10 million units sold in 2030 with a 22% EBIT margin. The base case, 7.7 million units in 2030. I just don't even. We also have 2025 EV EBITDA versus 2022 to 25 revenue compound annual growth rate. Bunch of different companies on here, including NIO, Li Auto, Nvidia, Spotify, Netflix, Apple, and so on. Again, if you want to pause and nerd out, go for overweight thesis, a double flywheel. We believe Tesla can leverage its cost leadership in EVs to aggressively expand its user base and over time generate a higher percent of revenue from recurring/high margin software and services. Correct? I agree, and this is very important. Oh wait, but isn't Tesla just a car company? Let's not think about that. Services drives the upside. We forecast Tesla's services EBITDA to account for 12% of total EBITDA by 2030 and 30% by 2040. I bricked up a little bit there, guys. They just said 2040. Wall Street analysts talking about 2040 as it relates to... is this real life? Is this real life? Is that really 2040? Is this a joke? It really says 2040. They actually mentioned 2040. I am impressed. Like, I actually am impressed. Valuation, supportive versus tech, including services, energy, and insurance in our forecast. At $250, Tesla trades at 10 times 2030 EBITDA and 2.1 times 2030 sales. Expensive versus auto, but not versus software and tech. We forecast... We forecast Tesla to sell 7.7 million units by 2030 and grow total revenue at 23% 8-year compound annual growth rate. Okay, a little bit of a breakdown of each case here. Bull case, $440 per share, 18 times 2030 EV/EBITDA. Morgan Stanley's bull case is literally half Tesla's own publicly stated goal. Now, admittedly, Tesla says it's going to be a stretch, but that's what they're aiming for. But the bull case, to me, it's so absurd that Morgan Stanley expect, in the best case scenario, the bull case, that Tesla falls dramatically short, catastrophically short of their publicly stated goal. Remember, in 2014, they were aiming for 500,000 vehicles in 2020. They got there. Now, they're aiming for 20 million in 2030. Morgan Stanley is expecting them to, at best, in their bull case, fall so dramatically short, they're only halfway there. The base case, even more absurd in my opinion. $250 per share, based on 7.7 million units in 2030. About one third of Tesla's publicly stated goal. And the bear case, $80 a share. I mean, let's read about this bull case. Okay, we're going to skip some of the bull. Okay, just a couple of highlights from this bear case. Okay, implies significant demand slowdown. Okay, margin contraction. And this is the kicker, with valuation falling closer to OEM peers, Tesla becoming more of just a car company further into the decade. Good luck with that. And finally, key earnings inputs. Total deliveries. 2022, they're looking at 1.37 million. We'll see how this shakes out. We'll know in a few weeks' time. 2023, 1.795 million units. And 2024, 2.4 million units. Free cash flow in 22, a little over 9 billion. 23, almost 14 billion. And 2024, just over 20 billion. I really do not think these estimates are going to age well. Investment drivers. Sales, China market announcements, pricing adjustments, Berlin and Austin gigaramp, Fremont battery pilot ramp, Cybertruck and new model announcements, emerging competition from traditional OEMs, startups and large tech firms, services disclosure. Risks to price target and rating. Risk to upside. Disclosure on service revenues. Increased FSD attach rate. Cost milestones on new battery. New model introductions. Cybertruck, multivan, semi. Third-party battery, as in supplying batteries to other companies. I think this will happen at some point, but only after Tesla can already meet their own internal needs, and that's going to be a while. Geographic penetration and new capacity. Risks to downside. Competition from legacy OEMs, yeah, not happening. And Chinese domestic, yeah, maybe. / megatech, I think they're referring to Apple there. Execution risk with multiple factory ramps. Failure for market to recognize services, and lower than expected attach rate and revenue per user. China risks, dilution, and valuation risks. So despite the fact that Morgan Stanley and I are light years apart in terms of our estimates, I'm much more bullish than Morgan Stanley on literally everything. We still agree on one key point. Tesla stock at these levels, what was the word they used? Opportunity. And that's putting it lightly. Now, I don't know for sure what 2023 will bring, but as I said, my prediction, which could be wrong, is that at some point during 2023, the stock market figures out that there's a gigantic disconnect between Tesla's intrinsic value and the current stock price. I'm not going to be waiting around on the sidelines to find out. Still buying with every spare cent. If I am right, unfortunately, those mean comments from the basement dwelling Tesla Q trolls are going to dry up rather fast, so dear turds, keep the comments coming in because I'm looking forward to a new installment of comments from the haters. Here's to 2023, the year of opportunity. P.S. Head over to Patreon now with the card in the corner or the link in the pinned comment and thank me later. Love ya.